For weeks, it's felt like the American economy has been, I don't know, running on fumes. Stale data, or in some cases, just no data at all.
Yeah, we've been in this unprecedented information blackout. It went on for, what, 43, maybe 44 days because of the government shutdown?
And that vacuum, it wasn't just an inconvenience for markets, for policymakers. It must have been genuinely unnerving.
Absolutely. The Bureau of Labor Statistics, which is, the official scorekeeper for all this, was completely dark. So this September jobs report, which was supposed to come out on October 3rd,
Right, ages ago.
and it finally lands on our desks on November 20th. That's a delay of 6, almost 7 weeks.
And its arrival now, this late, changes the entire game. Today, we're going to unpack this thing because it is probably the most consequential piece of economic data we'll get this quarter.
It really is. And the reason is simple. This is the last full official look the Federal Reserve will get at the labor market before their huge December meeting.
The one on December 9th and 10th.
That's the one. The stakes are incredibly high, and honestly, the data is just confusingly mixed.
Let's start with the headline figure then, because it was a surprise. U.S. employers added 119,000 jobs in September.
Right. And when you look at what people were expecting, that number seems really solid, a genuine sign of resilience.
Absolutely. The consensus forecast was, well, it was weak. You had analysts, firms like Bank of America, FactSet. They were all bracing for a number closer to 50,000.
50,000, yeah. They thought the summer slump had just continued. So getting 119,000, that's more than double that very low bar. On its face, it sounds like a powerful signal.
But is it?
Well, that's the question, isn't it? I have to be a little skeptical. If economists missed by that much, does it mean the economy is strong, or just that everyone had become incredibly pessimistic? We have to look past that headline. What we have here is a textbook mixed picture. That strong 119,000 number is immediately complicated by two pretty sobering factors. Some really shocking revisions to the summer months that basically rewrite history and, critically, a rising unemployment rate.
Okay, let's get into this puzzle. It's the definition of a split report. I'll start with the positive news first, that headline triumph, before we dive into the details that show the cracks forming just beneath the surface.
Sounds good.
So, that undeniable victory to kick off. Non-farm payrolls up by 119,000 in September. On its own, that suggests the labor market was not collapsing right before the data blackout.
It certainly suggests a bounce back, or at least that things weren't getting worse after what everyone was calling a dismal summer of hiring. It shows there was some resilience there right up until the shutdown started on October 1st.
And to really appreciate that number, you have to remember how low the bar was set.
Exactly. That 50,000 consensus estimate wasn't just pulled out of thin air. It reflected some real caution about a slowdown. So beating it by 69,000 jobs, that's a big deal.
But even with that strong beat, if we put 119,000 into a bit of historical context, it still feels slow, doesn't it? We got used to much, much bigger numbers.
We did. And that's a key piece of context. If you look at the 12-month average for hiring leading up to April of this year, the economy was adding about 147,000 jobs a month.
So we're still running below that recent average.
We are. And of course, if you go back even further to the post-pandemic recovery from, say, 2021 to 2023, we were often creating 300,000, even 400,000 jobs a month.
That feels like another era entirely now.
It really does. The slowing momentum is undeniable. But we also have to remember something important. The economy doesn't need as many jobs now just to keep up with population growth as it did 10 years ago.
Because of demographics and changes in labor supply?
Precisely. So while 119,000 is slow compared to that post-COVID boom, in today's reality, a lot of analysts actually see that number as solid. Maybe not spectacular, but not recessionary.
Okay, so where did these jobs actually come from? Was it broad-based hiring across the economy?
Not at all. It was heavily localized. And this is where the story gets interesting. More than 87% of all the gains came from just two industries.
And I'm guessing I can name the first one.
I'm sure you can. The consistent powerhouse, the one that defies almost every economic cycle. Healthcare and social assistance.
The demographic engine.
Exactly. That sector added over 57,000 jobs. To break it down, healthcare alone was 42,800 of that. And what's really important here is the consistency. It keeps adding jobs right around its 12-month average pace.
Driven by the aging population, it's just structural demand.
It is. Specifically, ambulatory services added about 23,000, and hospitals gained over 16,000. This is steady, predictable hiring, not some kind of cyclical boom.
That's a real bedrock of stability. So what was the other major driver?
That would be leisure and hospitality. Primarily, restaurants and bars. They added 37,000 jobs combined.
Which suggests that even with all the talk of inflation and uncertainty, people were still going out to eat in September.
They were. Consumers were still willing to spend. Beyond those two big ones, we saw some modest gains. The construction sector, which is very sensitive to interest rates, added 19,000 jobs. And retail gained almost 14,000.
So that clustering, it tells a story. It's an economy relying on services, healthcare, restaurants, and surviving. But maybe not exactly thriving in the goods-producing part of the economy.
That's a great way to put it. And predictably, the Trump administration took this 119,000 headline and ran with it as a pure victory.
Of course.
The Labor Secretary, Lori Chavez-DeArmor, called it a solid report. And she made a point of noting that 97,000 of the new jobs came from the private sector. The administration really framed it as a validation of their policies.
Now, beyond just the number of jobs, there were some other key figures in the report on wages and the labor force that also looked pretty healthy. Let's get into those.
Yes, this is where it gets a little technical, but it's essential for understanding the Fed's thinking. Average hourly earnings, they rose 0.2% for the month. But the big number is the year-over-year figure.
Which was?
Up 3.8% year-over-year.
And just remind us, why is that 3.8% figure so critical for the Federal Reserve right now?
It's all about their inflation target. For the U.S. to have a sustainable 2% inflation rate, which is the Fed's goal, economists generally think wage growth needs to be somewhere in the 3.0% to 3.5% range. So anything above that, they start to worry about a wage price spiral. Exactly. It allows companies to pay more without having to jack up prices to cover the costs. The fact that wages are still running at 3.8%, a bit hot, tells the Fed that the labor market, while it's cooling, hasn't cooled enough to completely stamp out inflationary pressures.
So great for the workers' paycheck, but a bit of a headache for the Fed.
Precisely. It keeps that inflation risk alive. Now, the other really positive element was the labor force itself. It expanded by a remarkable 470,000 people in September.
That's a huge number of people deciding to look for work. Why do we see that as a good thing?
Because it signals collective optimism. People enter the job market when they see jobs are available or when they feel they need to work. It suggests a certain confidence. The labor force participation rate actually ticked up to 62.4%, its highest level since May.
And in the long run, more workers should help ease wage pressures.
That's the theory. It increases the supply of labor, which acts as a kind of natural brake on inflation. So the picture from this first part of the report is payrolls beat, services led the way, and the underlying wage and participation numbers look solid, if maybe a little inflationary.
All right, so that's the good news. But as you said at the top, this report is the very definition of a mixed bag. So now we turn to the cold water. The shocking revisions, that rising unemployment rate, and the specific signs of weakness that maybe suggest September's headline was a bit of a mirage.
This is such a crucial pivot because this is where the official data starts to tell two completely different conflicting stories. When the BLS went back and crunched the final numbers for July and August, they just shredded the narrative of a strong summer.
How bad was it?
Total employment in July and August combined with 33,000 jobs lower than we originally thought.
And let's focus on that August revision because that one was just stunning.
It really was. So July was revised down by about 7,000 jobs to 72,000. But August was the shocker. The initial report was a gain of 22,000 jobs.
Okay.
They revised that down by 26,000. That massive swing flipped August from a gain into a net loss of 4,000 jobs.
Actual job loss
Yeah.
in August of 2025.
Yes, and that meant August joined June as the second month this year where the final jobs report was negative. Outside of the 2020 pandemic shock, having two negative months in 1 year is a very rare and pretty worrying signal. It confirms the labor market was really struggling before that little September bounce.
This volatility, it raises a really critical question that I think confuses a lot of people. How can the economy add 119,000 payroll jobs in September, but at the same time the unemployment rate goes up?
This is the absolute heart of the matter, and it comes down to the fact that the government uses two completely different surveys. We have to separate the establishment survey from the household survey.
Okay, break that down for us.
The establishment survey is where we get the big headline number, the 119,000 jobs. It surveys businesses, and it just counts the number of jobs on company payrolls. It's usually seen as more reliable for tracking job creation month to month. And the household survey, that's the one that gives us the unemployment rate. They call individual households and ask people, are you working or are you actively looking for work? It's more volatile, but it includes self-employed people, for example.
So the unemployment rate went from 4.3% in August to 4.4% in September, the highest since October of 2021. And that comes purely from the household survey.
Solely from that survey. And the reason it ticked up is precisely because of that big labor force surge we were just praising. Remember, 470,000 people jumped into the labor market.
Right, the optimism.
But the household survey only found that 251,000 of them actually got a job. So if the number of people looking for work grows faster than the number of people finding work, the unemployment rate has to go up. It's a sign of optimism, yes, but also a sign the economy is struggling to absorb all those new workers.
And that points to it being harder for job seekers. If we look deeper, are there specific groups that are struggling more?
The disparities are really concerning. While the overall rate just ticked up a little, the unemployment rate for Black women aged 20 and over jumped significantly, from 6.7% to 7.5%.
Wow, that's a big move for 1 month.
It's a huge move. And it suggests they're being disproportionately affected by whatever mismatch is happening between labor demand and supply right now.
And beyond demographics, which sectors were actually losing jobs in September? What does that tell us about the headwinds the economy is facing?
We saw clear declines in sectors that are really sensitive to global trade and corporate caution. Transportation and warehousing shed a big number, 25,000 jobs.
In manufacturing, that's been weak for a while.
Manufacturing lost another 6,000 jobs, which was its fifth straight monthly drop, and sources who are critical of the administration's trade policy directly link these losses to the uncertainty and rising costs from President Trump's tariffs.
The argument being that trade barriers disrupt supply chains and force companies to cut jobs.
That's the argument. We also saw the federal government continue to shrink, losing 3,000 jobs. And maybe the most important leading indicator, temporary help services, fell by 16,000.
Why is that one so important?
Because companies often cut temporary staff first when they get nervous about the future. It's a classic early warning sign of corporate uncertainty.
So the official September data is already complicated, with its own revisions and weaknesses. But the situation seems to have gotten much worse when you look at the flood of corporate layoff announcements that happened after September.
The layoff announcements paint a much, much darker picture for the immediate future. The outplacement firm Challenger Gray and Christmas said October was the worst month for job cuts in 22 years. We're talking about huge structural cuts.
And what are some of the big names we're talking about?
The scale is just immense. Verizon announced it's cutting over 13,000 employees. Amazon, mostly in its corporate ranks, slashed 14,000 jobs. Target, 1,800 corporate positions. UPS disclosed they've cut about 48,000 jobs this year alone.
And the list just keeps going. General Motors, Paramount, Nestle, Intel, Microsoft.
Procter & Gamble, it's an avalanche. And it creates an incredibly tough environment if you're trying to find a job right now. This is where the big data connects to the real human experience.
Like that story about the writer in Indianapolis.
Exactly. Highly qualified, lost her job. She applied for 200 different positions and got one single interview. She described the experience as feeling so cold and so distant. That really crystallizes the state of the market. It's a low-hire reality.
And the official data backs that up. The average time someone spends unemployed is now 24.5 weeks.
That's nearly 6 full months. It's the worst reading on that we've seen since November of 2017. So if you have a job, you probably feel pretty secure. But if you're looking, it is a huge challenge right now.
This mix of strong payrolls, awful revisions, and this rising anxiety over long unemployment spells, it puts the Federal Reserve in a nearly impossible position for its December meeting.
It's an incredible bind. The Fed's job is already hard because of its dual mandate. Keep employment high, but also keep prices stable with 2% inflation.
And the September data pulls them in two different directions.
Completely. The payroll number looks resilient, which is an argument to hold rates steady. But inflation ticked up to 3% in September, which is an argument to stay tough.
It's what Fed Chair Powell talked about. We have one tool. You can't address both of those at once.
Exactly. They have to choose. Focus on the inflation risk from things like 3.8% wage growth, or focus on the employment risk shown by the 4.4% unemployment rate and all those layoffs. And they have to make this choice while basically flying blind.
Because of the data fog, as Powell called it, from the shutdown, how bad is that fog?
It is crippling. This delayed September report is the last full data set on jobs they will see before that meeting. The BLS confirmed it. There will be no standalone October jobs report.
None at all.
None. They couldn't collect the household survey data during the shutdown. And the combined October-November report, that's delayed until December 16th.
Which is a week after their meeting is over.
A full 6 days after. They are setting policy for the entire U.S. economy based on a snapshot from early fall, while a storm of layoffs is happening in real time.
And this data fog is what's driving this huge debate over what they should do. Let's break down the two opposing arguments. First, the case for just holding rates steady.
The argument to hold is rooted almost entirely in that solid 119,000 payroll number and the still hot wage growth. The inflation hawks argue the economy is resilient enough, doesn't need a stimulus from lower rates. They point out that inflation is still stuck at 3%.
So cutting rates now could just pour fuel on that fire.
That's their fear. They believe the Fed should wait for definitive proof of weakness, and the September headline just didn't provide that. It gives them ammunition to wait.
Okay, so that's the hawkish view. What about the doves? What's their argument for cutting rates right now in December?
The doves ignore the headline and focus entirely on the downward revisions and the loss of momentum. They see the August job loss, the rise in unemployment to 4.4%.
The layoffs.
The massive layoffs. And they say this is definitive evidence the labor market is weakening fast. People like Fed Governor Christopher Waller have argued that a December cut is necessary to stop the deterioration before it gets worse. They're worried the demand for workers is collapsing, and they need to act preemptively.
It sounds like a true 50-50 call. Where is the market leaning on this?
Well, despite the passion on both sides, the market is leaning toward caution. Traders using the CME FedWatch tool are pegging the odds of rates staying unchanged at about 66%.
So a 2/3 chance they do nothing.
Right, and only about a 1/3 chance of a cut. The thinking is, faced with this much fog, the Fed will probably just choose to wait until they get clearer data in January. The September headline, even with its flaws, bought them some time.
And how did the markets react to the report itself? It seemed like everyone found something they liked.
They absolutely cherry-picked. The stock market loved the payroll beat. They saw 119,000 jobs and thought, okay, the economy isn't crumbling, so stocks went up.
But the bond market?
The bond market focused on the rising unemployment rate and the slightly slower monthly wage growth. And they thought, okay, that's less inflationary. So Treasury yields went down. The report basically just reassured everyone that the absolute worst-case scenario wasn't happening, at least not in September.
Finally, we have to talk about the big external pressures that are making all of this even more complicated for the Fed.
There are four big structural headwinds converging. First is the constant uncertainty from President Trump's tariffs. Critics blame them for raising costs and link them directly to the job cuts in transportation and manufacturing.
Then there's the technology factor.
A huge one. The growing role of artificial intelligence. There's a real trend of what some are calling jobless economic growth, where AI allows companies to be more productive without hiring more people. It really messes with the traditional employment math.
And of course, the lingering effects of the high interest rates themselves.
Exactly. The medicine is still working its way through the system, slowing everything down. And finally, on the supply side, you have reduced labor supply from the administration's crackdown on immigration and from retiring baby boomers. All four of those things mean the Fed isn't just fighting a normal cycle, they're navigating these massive structural shifts.
So after all of that, what does this actually mean for you, for someone just trying to make sense of the economy right now?
It means we are stuck in what economists are calling a low-hire, low-fire limbo. If you have a job, things are probably stable. We know that because weekly jobless claims are still historically low. Not a lot of people are being laid off.
That's the low fire part.
Right. But at the same time, we have very weak hiring. We see that in the downward revisions, the long-term unemployment numbers, and the trouble those 470,000 new people had finding work.
So security if you're employed, but real difficulty if you're looking.
That's it exactly. If you're one of the millions with a job, you feel relatively safe. If you've lost your job or are just trying to get into the market, that nearly 6-month average search time shows how incredibly hard it is right now. The strong headline number really masks a fragile system underneath.
And for the Fed, operating in this data fog.
This September report isn't a guide. It's more like a mirror, reflecting a single moment of resilience before things got much rockier. It showed an economy adding jobs despite all the headwinds. But that mirror cracked as soon as we saw the revisions and layoffs that came right after. The Fed is facing immense pressure from both sides to act, but with stale, limited information.
So as we look ahead, we need to leave you with the central question the Fed will have to answer, and it has to do with how we even think about job creation anymore.
It all comes down to the new reality of labor supply. Because of less immigration and more retirements, some economists now think the economy only needs to create between 30,000 and 50,000 jobs a month, just to keep up with population growth, not the old 150,000 benchmark.
And if the new break-even number is only 50,000,
That 119,000 isn't just solid, it's wildly strong. It would signal an overheating market.
that completely changes the context.
It does. So the central puzzle for the Fed is this. Is the current slowdown we're feeling caused by a long-term reduction in the labor supply? Meaning we aren't creating as many jobs simply because there aren't as many workers available? Or is it driven by a reduction in the demand for workers because of high rates and tariffs and AI, which is what people like Governor Waller fear? Because if demand truly collapses, we'll see a much steeper spike in unemployment very quickly. Answering that question, supply versus demand, will determine everything they do next.